Hello everyone. In this video, we're going to be going over long-term construction contracts basics. Okay, so there's basically going to be two videos for this topic, at least two videos. I haven't completely decided how it's going to look yet, but basically there's going to be one video for this basics packet, okay, which is 9 pages long. And then the second packet is like around 11 or 13 pages. It's for the advanced topics for long-term construction contracts, okay? That one might get split up into a couple of videos just because it is so long. And I'm not sure how long the video is going to be, so I might have to split it up a little bit. But this should all be able to go in one video. Okay, here we're just going to go over some basic information, and then we're going to walk through two practice problems that are pretty lengthy. This is one of the, biggest topics in the class. It's not incredibly challenging in the sense that it takes time to learn for sure, and it's difficult at first, but once you get it down, it's literally the same thing every single time over and over again. So that's the good news. So if you put in the time up front, yes, it's challenging up front, but once you've got it down, you've got it down. There's nothing that they can really do in terms of asking questions. There's not much they can switch, and we're going to look at all the different variations that you would need to know, okay? So what is a long-term construction contract first? It's an agreement to construct an asset for over a lengthy period of time. We're going to go through this stuff relatively quickly because in the problem, we're going to be taking a lot of time to actually explain all these things, okay? It presents issues, the long-term construction contract, they present issues as to the proper period of when to recognize revenue. Okay, that's the issue here is when are we going to recognize revenue? This is a topic within the overall topic of overall revenue recognition. If a company can estimate its progress towards completion of the project, it uses the percentage of completion method, which we're going to cover later. And then if it cannot estimate its progress towards the completion of the project, it uses the completed contract method, which we're going to cover in a minute as well. A company recognizes revenue over time if it meets one of the following criteria. And this is literally a direct copy and paste from the codification. Okay, so if you meet one of the following criteria, you have to recognize revenue over time, which means you're using the percentage of completion method. Okay, the customer simultaneously receives and consumes the benefits of the seller's performance as the seller performs. The entity's performance creates or enhances an asset, for example, work in process that the customer controls as the asset is created or enhanced. And then finally, the entity's performance does not create an asset with an alternative use to the entity, and the entity has an enforceable right to payment for performance completed to date. Okay, again, this is just something to be aware of. Don't necessarily need to have this memorized verbatim, but if you meet one of these criteria, you will use percentage of completion method. So what is percentage of completion method? It's a method of accounting for long-term construction contracts that recognizes revenue based on the progress of the contract. Okay, so you're recognizing revenue over time. You have to determine basically over time how much percent am I done, and then based off of that, if you're 10% done, you recognize 10% of the revenue. If you're 20% done, you recognize 20% of the revenue. Okay, again, you must meet one of these criteria to use this method. To determine how much revenue to recognize each period, companies must have a way of tracking progress towards completion of construction projects, right? So you have to have a way of tracking your completion of these construction projects, right? Because otherwise, how are you going to know how much revenue to recognize? So two commonly used methods are input measures, okay? So this tracks completion using efforts or materials expended to construct the asset, such as costs incurred or hours worked. Okay, so input measures are things like, again, like the amount of costs you incur, the amount of hours that you spend on the project. So they're things you're putting into the project. So they're efforts that you're expending or materials that you're expending to construct the asset. Okay, output measures tracks the completion using actual output, such as floors of a building or miles of road built. Okay, so output is what comes out of the project. Input is what you would put into the project. Okay, again, these are just ways that companies can track their projects toward the completion of a construction project. Okay? We use input measures in this class, so we use this first one, and we track the cost incurred to construct an asset. Okay, that's really the most widely used one, so that's the reason that we use it in this class. So it's called the cost-to-cost method. It tracks the costs incurred to date versus the total estimated cost to complete the asset to determine how much revenue to recognize. So basically what we do is that we say, we've incurred $10 to date, and we think we're going to incur $40 overall on this project. Well, that means we've incurred 25% of the cost, so that means we can recognize 25% of the revenue. That's basically what we do. Obviously, that's a relatively simplified version of the actual problem itself, but just to get an idea of what's going on, we have just a simple example there. Additionally, we accumulate both gross profits and costs in the construction in progress or process KIP account. Okay, we're going to call this the KIP account. Okay, that will make sense more when we actually work through the problem, but just a quick note there. Then completed contract, it recognizes all revenues from the project in the period the project is completed, so we're not recognizing revenue over time, okay? Used by companies when they don't meet the criteria to use percentage of completion method, and we accumulate only costs in the KIP account, okay? In the construction in progress or process account. You can call it construction in progress, you can call it construction in process, it means the same thing, okay? So, basically, that is our quick introduction. Let's go ahead and jump into some problems. First, before we do that, one more thing. We have these formulas for percentage of completion that we're going to use. Okay, the first one is that the percent complete is the cost incurred to date divided by the estimate of all costs for the project. Okay, then our revenue or gross profit to be recognized to date is the percent that we are complete with the project times the estimated total revenue or gross profit for the project. And then we have current period revenue or gross profit to be recognized to date minus revenue or gross profit that we've recognized before, right? So current period revenue would be the total revenue we're allowed to recognize, right? If we're allowed to recognize, $500 of revenue, but we've already recognized 400 before, well, that means we can recognize 100 this period, right? We're allowed to recognize 500 as a total for 2 years combined. Last year we recognized 400. That means this year we recognize 100. Okay, we'll be using these formulas a lot when solving these problems. Okay, so let's go ahead and jump into a problem. The first one is going to be the construction in process KIP problem using the percentage of completion. Okay, so let's go ahead and get as much of this as we can on one page. This right here is kind of the math behind what we're doing in the journal entries. Okay, so we're going to need to use this paper. Okay, so let's just go ahead and jump into this one. XYZ company is in the construction business and specializes in constructing apartment buildings. On January 2nd of 2016, the company began a project to build a 10-story apartment building for a contract price of $10 million. The company estimates that the apartment will cost $8 million to construct, and the following information is available concerning the construction of this apartment building. Okay. Then we're given a bunch of information for 2016, 2017, and 2018. Okay, we're given information about costs incurred, estimated cost to complete, progress, billings, and cash collected. Okay, this is generally how you're going to see these problems. They're going to give you a contract price. Okay, a contract price is how much the company is going to get paid. That's basically revenue to us, right? Then there's an estimate of cost. The estimate of cost is saying, at the beginning, we think we're going to spend $8 million to make this. Okay, well, we think we're going to get revenue of 10, cost of 8. That means $2 million of gross profit, right? Then it's going to give us all this information about 2016, 2017, all the years that we have for the project is going to give us this chart here. Okay, now, a couple things to be aware of with the chart. Okay, the first thing is just identifying the items in the chart, right? So the first thing is the cost to date, okay? That's the cost that we've incurred to date, right? So for instance, in 2016, we've incurred, up till the end of 2016, we've incurred 2 million costs total, right? Then in 2017, we've incurred 5 million by the end of 2017, right? So that would mean during 2017, we would have incurred 3 million of costs, right? Because we've incurred a total of 5 million by the end of 2017, and we incurred 2 million in 2016. 2 million plus 3 million equals 5 million, right? So we have to be careful with the reading of the chart, right? Because this could say cost to date, or it could say costs incurred in each year, right? If it said cost incurred in each year, all of a sudden, this stays the same, but all of a sudden, this is now $3 million, right? But we still need to remember that for our formula for the percentage complete, right, as we just went over, we need to find that cost incurred to date. We're going to need to use that, okay? And so we're going to still need to keep track of the $5 million, okay? So part of this is just reading comprehension, making sure that you're reading the problem correctly the way that they've presented the information to you, okay? That's the first thing to note, okay? The other thing to note is just don't get worried too much. We will go through basically every single one of these things, what they are and what the journal entries are in just a minute. The other thing you want to know is that the estimate of the total cost can change over time, and that is going to make a difference in our answers, okay? Other than that, let's just go ahead and keep moving. And we'll talk about these things in just a minute, okay? The building was completed on December 31 of 2018, okay? So it started in 2016, the beginning of 2016, and it was finished at the end of 2018. Then it says required prepare all the journal entries for XYZ company for 2016, 2017, 2018, assuming that the company uses a percentage of completion method. Date all entries December 31 of the year. Okay, this is just given in there so you know what the date is, because otherwise sometimes it's a little bit confusing. Okay, so first we have the costs incurred to date. Okay, and so basically whenever we have costs incurred to date, okay, this is always our journal entry. Okay, whenever we have these costs, whatever the amount of costs we incur in the specific year. So the first year we incur $2 million, right? Because costs incurred to date would be the same as costs incurred in 2016, because that's the first year that we're doing the project. So we debit the account called construction in progress, or KIP. Okay, KIP is generally fine in the exams. The professor is usually okay with that. And then you're going to credit something like cash, materials, payables. These are all the things that you're using to construct the asset. Okay, so what you're doing here is that you're saying we're constructing a building. Okay, this KIP account is an asset account. Okay, and what we're doing is that we're using materials, we're using cash, we're incurring payables of $2 million to construct this building, right? That's what this company, this construction company XYZ, would be doing to make this building, right? They'd have to pay out some money, they'd have to buy materials, they'd have to incur payables, right? And this account, this amount of $2 million that we actually expend is going to be capitalized into an asset account, because eventually it's going to be a building that these people are going to sell, right? So that means that this is an asset to XYZ because it represents future revenue to them, right? It represents revenue to them because they are going to be able to sell this 10-story apartment building to the company that they're making it for. Okay, so that's what we always do. We just capitalize the amount of the cost that we incur. That's our first step. And then we credit out materials, cash, payables, something that makes sense. Okay. Our second step is to record our progress billings. Our progress billings, okay, all that is basically recording accounts receivables. Okay, so what we're saying is that we're billing the customer. Okay, so we debit accounts receivable to show that we've billed the customer and that they owe us money. Okay, then we're going to credit an account called billings on KIP. Okay, now billings on KIP is basically going to be a contra asset account. Okay, this is a contra asset account to the KIP account. Okay, and so basically what happens is that in this case we end up billing $1.5 million. Okay, now the reason that we're crediting this billings on KIP is because we don't want to double count the asset, right? So what does that mean? Well, it means that we debited construction in progress, right, for $2 million, right? So that means that as of the end of 2016, we basically have $2 million of assets, right? In the sense that we're capitalizing these costs, right? So that would be an asset to us because we're going to sell it in the future. Then we're debiting accounts receivable for $1.5 million, right? Because we're actually billing that out, which is what we would do, right? The issue is that if we don't credit something such as a contra asset account to reduce the balance in the KIP account, right? This is a contra asset to the KIP account, okay? Billings on KIP, okay? If we don't credit something like this, we're going to overstate our assets, right? Because then we would actually have 3.5 million of assets as opposed to 2 million of assets, right? Because now what we have is we have the KIP account at 2 million, and then we have the billings account at 1.5 million subtract. So it's reducing our value of KIP on the asset side to $500,000. Then we also have an accounts receivable sitting on the books at $500,000, right? So we have a total of $2 million of assets, which is what we have, right? That's the total amount of assets, right? If we don't make this credit to KIP, then we would have 3.5 million of assets, which is clearly overstating our assets, right? We only have 2 million of assets. Okay, so that's why we're making that entry. Okay, and this entry is always equal to the amount of the progress billings each year. Okay. Now again, this is progress billings per year. It's not progress billings to date. Okay, so each one of these numbers is already given to us in the amount that is done during the year. So 1.5 million in 2016, 4 million, and then 4.5 million in 2017, 2018 respectively. Then we have the cash collected. That journal entry is very straightforward. We already know how to do that. That's just debit cash, credit accounts receivable for the amount that they tell you. Okay, that one should not be too challenging. We're just going to move through that one quickly because, again, that's not new to this topic. We should, by this point in the class, understand how to collect an accounts receivable, right? Then we have our final journal entry here, which is going to record the gross profit for the current year, okay? Because, again, we're using the construction and process percentage of completion method. We're using the percentage of completion method. and we're using the percentage, when we're using the percentage of completion method, we have to record revenue and expense each year in our gross profit. Okay, we're going to record our expense and our revenue and our gross profit every year of the contract. Okay, that's what we're doing in percentage of completion method. Okay, so first we have to determine how much revenue is going to be recognized. Okay, so how do we do? So what we're going to do for this is that because this is going long, we're going to go through, because we're taking so much time on this first year, we're going to move through the second and the third years a little bit faster, especially with some of these first journal entries. This is the last one we'll spend more time on, but these first journal entries, we've gone through them and they're literally the same thing every year. All that changes is the numbers. And so we'll move through those a little bit more quickly, but let's spend time here because this is the hardest part of these problems. Okay, so we can look over here now. Okay, so again, the revenue that we're going to recognize, okay, so the revenue that we're going to recognize is going to be the percent complete, which is defined up here, times the estimated total revenue. Okay, so the percent complete is the cost incurred to date divided by the estimate of all costs for the project. Okay, so the cost incurred to date would be 2 million, right? And then the estimated total costs would be 8 million. How do I get 8 million? Okay, right here, estimated total cost of 8 million. How do I get this? Well, I combine the 6 and the 2. Right? Because we've already incurred 2 million and then we think we're going to incur another 6 million. Okay? That matches up with the $8 million that we thought it was going to be at the beginning. Again, it doesn't always have to match up because our estimates can change over time. As I talked about at the beginning, the contract price will always stay the same, but the estimate of the total cost could change. And we'll see in 2017 that actually does happen. Okay? So the estimated total cost is, again, the amount we've incurred to date plus what we think we're going to incur in the future, the estimated cost to complete, right? That makes sense. Okay, so we've incurred 2 million to date. We're going to incur 8 million total. That's what we think, which means we're 25% complete, right? Because we've incurred 2 million out of 8 million total costs. That's 25%. 2 divided by 8 is 25%. Okay, then we take our percent complete, we multiply by our total revenue. That means we can recognize $2.5 million of revenue to date. Okay, then our formula says subtract out the revenue that you've recognized in prior periods to get the revenue that you can recognize this period, right? Because if you can recognize a total of $2.5 million to date, but you've already recognized a certain amount in the prior periods, then that means you can't recognize that full amount this period because you've already recognized some of that revenue in the past periods. However, this is our first period, right? So we don't have to worry about that. We haven't recognized any revenue yet. So that means we're going to recognize $2.5 million of revenue this year. Okay? So in our journal entry here, we'll see that our credit to revenue is $2.5 million, right? Because, again, we're allowed to recognize 25% of the revenue of 10 million. Okay, 25% of 10 million is $2.5 million. Then our construction expenses are equal to the cost we've incurred to date. Okay, so generally speaking, except for in one case, you can just memorize this. This is just a fact of these problems. Okay, the construction expenses is, except for in one case that we will look at in the advanced topics videos, the construction expenses always equals the cost that you incurred during the current period. Okay, so we incurred 2 million of costs in the current period. That equals our construction expense. Okay, then the balance to make the journal entry balance, the debit goes to the KIP account. Okay, that's when we accumulate our gross profit in the KIP account. Okay, so if we flip back to our first page, it says we accumulate both gross profits and costs in the construction and process KIP account. Okay, so our gross profit is here, right? Because the revenue minus the expenses would be our gross profit, and that would be housed in our KIP account. Also, the costs we incurred, we debited to KIP, right? That was the other thing we said we're going to put into the KIP account. Okay, so now we can see that from these first set of journal entries, we've done that, right? We've capitalized the cost, and then we've also capitalized the gross profit for those costs. Okay, so that is the first year of the problem. Okay. Now let's move to the second year. Again, we're going to speed through these entries because they are very straightforward from the standpoint of once you understood them from the first part. If you need to go back and rewatch that, that's fine. But they're literally the same debits and credits. All that changes is the amounts, okay? And the amounts are not super hard to derive. Okay, we'll just go through them quickly. Okay, so the KIP account is debited for $3 million because, again, this is costs incurred to date. So $5 million total minus $2 million in the prior year would be $3 million. Okay, and then we're crediting materials, cash payable, something that makes sense. Okay, let's just do the final year really quick. It's going to be 3.5 million, so that way once we get there, right? Because if we've incurred 8.5 million total, and then we incurred 5 million through the end of 2017. That means 2018 must be $3.5 million. Okay, so that we already have that done. Then the accounts receivable billings is $4 million. Again, we're doing this because we're trying to make sure we're not double counting our assets. Okay, and that's how we do it, by doing this credit to billings on KIP. Okay, then we collect $6 million in cash. That's just cash and accounts receivable. Nothing too crazy there. Okay, now we have to do our calculations. Again, we can already see construction expenses is $3 million. And again, that is the construction expense that we recorded this year. And again, that will hold true for every single case except for one case, which we will go over in the advanced topics video. Now we just need to determine the revenue that we need to record. Okay, so if we go to our calculation sheet, we can see the cost we've incurred to date is $5 million. This is just a repeating of the facts. We've incurred $5 million to date, and now at the end of the year, we think we're going to incur another $3.5 million total. Okay, so that means that we're going to incur overall $8.5 million. That's our best estimate as of the end of 2017, is that we're going to incur $8.5 million on this construction project. That's gone up. The estimate of cost has gone up, right? It used to be that we thought it was going to be $8 million. Now we think it's going to be $8.5. Okay, but our calculations don't change. Okay, we still do the calculations in the same way. Okay, for this basic example. And the reason that we're going to do the calculations the exact same way is because we're still in a situation where we have an overall profit on the contract. Okay, this is kind of the important inherent assumption that we have within these first two. Okay, the overall contract price is what? It's $10 million, right? And so in that case, if we're going to incur $8 million or we're going to incur $8.5 million of expense, either way, we're still going to make a profit on the contract as a whole, right? And so in that sense, that means that we're still going to recognize revenue on this, okay? So that means we're just going to keep chugging along and doing our calculations, okay? We'll see how that changes once we get into a loss situation in the advanced topics, okay? So again, costs incurred to date are $5 million. Total costs are $8.5 million. That means our percent complete is 59%. Just $5 million divided by 8.5. Okay? That allows us to recognize, this is rounded, so that means we're allowed to recognize 59% of $10 million, so we can recognize $5,882,353 for the overall to date. That's the amount of recognized revenue we're allowed to recognize to date. Okay? However, we've recognized $2.5 million in the prior period, right? Which means we can't recognize that revenue this period because then we will double count the revenue, right? We've already recognized that revenue in the prior period. So that will mean that we can only recognize $3,382,353 of revenue, okay? And that is what we credit, $3,382,353, okay? Then we do the difference to get our gross profit, which again is just our revenue minus expenses, goes to the KIP account, okay? So that would be our second year. Okay, we just determined that our total revenue we can recognize to date is about $6 million. We subtract away the $2.5 million that we've recognized in prior periods, because again, we can't recognize that revenue again. We've already recognized that in prior periods, and then we get $3.38 million, $3.82 million. The reason that we're subtracting this is because within this about $6 million, $2.5 million is already included within that, right? Because this is the total percent complete, and this is the total revenue we're allowed to recognize to date. Okay. So that is the end of the second year. Let's go through the last year very quickly here. What we're gonna do is that we're gonna do a separate video for the completed contract method, just because this video is getting pretty long. I didn't realize it would be this long at this point. So we're just gonna do a separate video for the basics completed contract method as well. So again, these first journal entries are very straightforward. We already solved for it. It's gonna be KIP and material cash payables, $3.5 million. Accounts receivable, progress billings on KIP is $4.5 million. Then cash collected was 3.1. Accounts receivable goes down by 3.1. Then we just have our last couple journal entries here. Okay, let's flip back to our page. Okay, we can see that, we incurred $8.5 million, which is what we thought we would incur last year. We don't have any additional expenses to incur, right? Because again, we're done with the project as of the end of 2018. That's what it said in the problem. We finished at the end of 2018, and so we don't need to worry about any additional costs. So now we're 100% of the way done, right? Because we've incurred $8.5 million. We think we're going to incur a total of $8.5 million. That means we're all the way done. That means we're allowed to recognize $10 million of revenue to date because, again, we can recognize the full amount of the contract price at this point because we're completely done, right? However, we've already recognized $5.8 million in previous periods. That means we're allowed to recognize $4,117,648 of revenue, So we recognize that. Again, our construction expenses equal the amount that we debited to KIP at the top because that's the amount that we actually incurred to make this project. And then the KIP is the difference. Okay, so then the very last journal entry we make is to actually remove the KIP account. Okay, once we actually make the sale. So we debit billings on KIP because again, billings on KIP is a contra asset account to KIP. Okay, so we debit it to remove it because it would have a credit balance of 10 million, and then we would credit KIP to remove it as well because we're making the sale. Okay, this is basically saying we're making the sale, we're getting rid of it at the end of the period. Okay, at the end of 2018. Okay, so this is a journal entry we make once we're done with the project. Okay, only at the very last year. We just make the entry to remove the billings on the KIP for the 10 million, and then we remove the KIP account for 10 million. This is how it works under the percentage of completion method, because the way that it works is that for this method, you would have accumulated $10 million in the billings on KIP and $10 million on the KIP account for both of those accounts, right? And the billings on the KIP is easy to see because, again, it's always this progress billings line. So we just add those up. 1.5 plus 4 million plus 4.5 million is $10 million would be in billings on KIP. And then the KIP account, okay? Again, remember, we debited KIP for these costs at the top here, right, each year. So that would be 2 million, 3 million, and 3.5 million each year. And then again, we debited KIP for the gross profit. So if we add those up at the bottom there, those are the gross profits that we debited to KIP each year. We end up with another 1.5 million plus 8.5 million will give us 10 million on KIP. Okay, so sorry to go so quick on the last part. If you need to rewatch that, that's fine. I'm just trying to get this video a little bit shorter so that way we can not go to an insane time limit. We're gonna do the other construction in process, the completed contract method in another video. That's the end of this video, and I hope that helped.